Hi everyone, welcome to another episode of Phillip Futures Trading Podcast. My name is Liao and today we will have Trent from Phillip Futures with us. How are you doing, Trent?
Yeah, I'm feeling good today. I'm excited to be back.
Thank you, Trent. Glad to hear that. Now, in the previous episode, we talked about how to hedge your stock portfolio with CME Micro E-mini Futures. If you have missed the previous episode, please visit our YouTube channel and you can find all of our podcasts and all previous recorded webinar sessions there. So this week, we will discuss on which sectors in the US stock markets to watch in the second half of 2021. As the first half of 2021 has come to an end, let's review the performance of the top sector in the US stock market. Next, we will also discuss on the potential sectors that investors should watch in the second half of 2021. Now, Trent, as the US economy is opening up and with trillions of dollars of stimulus packages from the US government, do you see a solid fundamental economy recovery or a fragile recovery in the first half of 2021?
Okay, so in my opinion, the US economy is currently on a solid path of recovery. So the US economy grew at a solid 6.4% rate in the first 3 months of the year. So it's quite a huge figure, setting the stage for what economists believe may be the strongest year for the economy in about 7 decades. Also, a report from the Commerce Department showed that the May orders from US factories, right, for big ticket manufactured goods rose for the 12th time in the last 13 months. It's a fantastic figure. So factories in the US are anticipating a return to normalcy or better and are ramping up their operations to match the consumer demand, which has helped the jobless claim to tick lower, of course. The number of Americans applying for employment benefits also dropped last week as the job market continues to heal, despite more slowly than the economy expected at this point of recovery. Jobless claim actually fell by 7,000 from the previous week to 411,000. Okay, even though the job growth has not met most of the economic expectation, Americans actually also spending money and consumer spending grew at a sizzling annual rate of 11.4%. It's quite a huge number in the first 3 months of the year. Business investment also grew at a strong 11.7% rate, better than the previous estimate of 10.8% growth, while government spending increased at a rate of 5.7%, slightly below the last month estimate of 5.8% gain. So overall, I would say the US economy is on a steady recovery path.
Yes, indeed. With the growing consumer spending, we shall see a steady recovery path for the US. Now, Trent, also, which sector do you think had the best performance in the first half of 2021? And is it a sustainable one after the pandemic period?
Okay, so the S&P 500 actually has jumped 16% this year, very much better than the index 7% decline as of last year, mainly due to the pandemic. After crashing last year, right, the energy stocks continue to hit up the index gains with top performers such as Marathon Oil, which up nearly 100%, while Diamondback Energy, Occidental Petroleum, and Nucor all have jumped at least 78%, so quite a huge gain. And also, one thing to take note is that 6 of the S&P's top 10 stocks this year are actually from the energy sector. So we can say the energy sector is performing greatly this year. Another sector would be the financial sector this year, which is the second best performing in the S&P, which have gone up by 24%, while the real estate and communication service follow closely behind, climbing only 23% and 19% respectively. Okay, so looking ahead, right, investor will have to be a little pickier about which stocks to hold. One thing to note is that oil prices probably aren't going to go up another 50% from here, so because they're already at high. And also industrial and bank stock can keep working as the economy continues to grow. So investors can look at industrial and bank stock. As for tech sector, all winners like Amazon, right, could gain momentum if the investor believe that business fundamental had caught up to the stock price. So whatever happens, just don't expect the second half of the year to look like the first. The market will have surprises in the second half of 2021.
Yes, I agree with you. The market will always give us a surprise. Now, as we have seen in the commodities market where it has been very volatile this year, now let's talk a little bit on commodities market. With the commodities market super cycle starting to fade, are we expecting another superinflation in commodities in the second half of the year?
Yes, commodity prices have started to come off the buoy. So basically, soybean futures have lost all of their gains for 2021, while corn, platinum, and nickel has also retraded. US timber prices have gained 400% in a year, but have fallen by more than 1/3 over the past few months. However, not all commodities have dipped. The likes of tins and oil still remain buoyant. Brent crude oil hit 2-year high of $75 a barrel this week. So while that's blown away some of the speculative fraud from the market, the big question is whether the latest commodities bull run has passed its peak or is it taking a breather. Either way, the direction may not be broad-based, with each market having its own individual characteristic. Okay, so let's start with copper. So copper traders actually need to balance out a short-term cooling in China with long-term green energy prospects. Copper bulls are confident that the rest of the world will pick up the slack as renewable energy and electric vehicle investment create a step change in demand in Europe and North America. This could still take a while before that spending makes its way to the factory order books, and softer demand in meantime could support copper bears who say current high prices are unjustified by fundamentals. Next, the oil market. So the oil market dip could be limited due to falling stockpile and also supply concerns. For now, it looks as though the market is going to need extra supply in the second half of the year. And also worth noting that the OPEC group, right, is yet to confirm plans for production beyond July, while US shale producers remain disciplined in their production restriction as they are making money again. Also worth noting that the current focus is on when the market will see the Iranian supply return as talks with the US continue. Okay, next will be the iron ore market, which we saw whipsaw due to the Chinese policy. Both bull and bears, right, are keeping a close eye on China's simultaneous goals to contain the inflationary pressures stemming from the high commodity prices and to make it vast steel sector greener. The country's output is still on track to smash another record this year, but also we'll have to see actions from the authority whether to restrict production, and we may expect iron ore prices to be volatile. Last and most interesting one would be the gold. Gold is largely depends on the whether Federal Reserve will start tapering or not. Although the precious metal is often bought as a hedge against inflation, the Fed signaled that higher than expected inflation would not be allowed to persist, so opening up the door for faster stimulus tapering. So this will definitely have an impact on the gold market.
Now let's talk about the stock market. So in the second half, should investors continue to put heavy weight on the tech stocks? Are they overvalued?
Okay, so the S&P technology sector giant such as Microsoft have become the second largest US company to surpass a market value of 2 trillion last month, right? Quite an amazing achievement. And also Apple is now valued at 2.3 trillion, such a huge company now. Apple is now 5.9% of the S&P 500, and Microsoft is now 5.6% of the S&P 500. So the information technology sector accounts for more than 27% of the S&P 500, which is more than any other sector, including the number 2 healthcare sector at 13%. So definitely technology sector will have a big impact on the market. However, in my opinion, right, the current valuation of the US tech stock is fairly priced, as the average of the PE of the major tech company like Apple, Microsoft, and TSM currently stands at 30 times, which is the sector average. Then also we have some other company like Nvidia, Adobe, and Salesforce, which has even higher valuation at around 50 times PE. So investors should really wait for a pullback of valuation back below the sector mean of 30 times before deciding to enter into this company. However, with that being said, right, the growth potential of the US tech sector remains solid, premised on the reopening of the US economy and also a fundamental switch in workplace environment due to the pandemic. All in all, we may potentially see another bull run in the US tech sector after a potential correction.
Yes. In fact, the pandemic has already changed our lifestyle tremendously. Now, with the US indexes hitting new highs recently, are we expecting a peak this year or not until the Fed's scheduled interest rates rise by 2023?
In my opinion, the bull run in US stock market has yet to end. As mentioned previously, the US economy is still continuing its recovery path at a strong pace. Inflation data, consumer spending, and even the labor market is actually showing a very promising sign. So the only risk remaining is concerns about the inflation, which has increased speculation that the Federal Reserve would be forced to take steps to slow down the economy. If inflation continues to run hot for long enough, right, I reckon the central bank would be forced to act more quickly than the market expects and cause stocks to tumble. So investors really have to watch out for the action from this Federal Reserve.
Okay, yeah, let's see how the US market will perform in the second half of the year. Thanks for sharing, Trent. Now, for our audience out there, if you wish to trade a US CFD, you can now trade one US share CFD with Phillip Futures for only 0.3% commission rate or a minimum of $10. So this promotion is valid from 1st of July until the end of the year, 31st December, for our new and existing CFD clients. If you'd like to know more on the promotion, please do not hesitate to visit our website and leave us a message, and one of our representatives will contact you accordingly. Now, before we wrap up our podcast, I would also like to announce that we will be having an upcoming webinar on next Wednesday, the 7th of July, from 7 p.m. to 8:30 p.m. The title is Second Half 2021 Outlook, Tapering of Taper Tantrum. If you'd like to register for the webinar, please log on to our website at phillipfutures.com.my and register on our webpage, or you can also speak to one of our representatives for the registration. Now we have come to the end of our podcast. Once again, thank you, Trent, for being here today. Goodbye.
Thank you. Bye.